Good morning, everyone. This is the stakeholder meeting to discuss the Office of Consumer Credit Commissioner's rule review for property tax lenders. My name is Matt Nance. I'm the OCCC's Deputy General Counsel. I'm joined by several members of the OCCC staff, including our Commissioner, Leslie Pettyjohn, General Counsel Michael Rigby, Assistant General Counsel Lori Hobbs, our Director of Consumer Protection, Rudy Aguilar, Senior Review Examiner William Purse, and our Manager of Licensing, Moran Zepeda. And I'd like to turn things over to Commissioner Pettyjohn to make a couple opening remarks.
Thank you, Matt. Good morning, everybody. First of all, let me say welcome. Thank you for being, those of you that are here in the room and those of you who are joining us on the webinar. We want to welcome you to this meeting. Stakeholder meetings are a vital tool that we use in developing rules, and I know this particular action and rule review has already generated a lot of early comment, and we appreciate that. We're certainly looking forward to engaging in the process here as we work to review these rules and to implement some legislation. So again, thank you for your participation in the process. We aim to have a very open and transparent process, and so we welcome your continued feedback, and I'm looking forward to the process. So I'll turn it back over to Matt.
Okay. Like the Commissioner said, I want to thank everyone for coming to our meeting as well as listening online. Getting input from stakeholders is a really important part of our rulemaking process, and these meetings help us make sure that we produce the best rules possible. We are holding this meeting on GoToWebinar in addition to having it in person. Some of you might be listening on your phones, some may be watching on your computers, and some may be doing both. For those of you watching on your computer, there's a window where you can submit questions. If you have technical questions about using the webinar, you can type them in that window and Lori will try to answer those. If you have any questions or comments on the rules themselves, you can type those in at any time and I'll be getting to those as well. And if you're on a computer with a mic, there's a function allowing you to raise your hand and we can let you make a comment verbally. For those of you here in person, we do have a table where you can come up and share your comments if you'd like. If you have shorter comments or questions, you can share them from your seat, kind of town hall style. But keep in mind that if you do that, I'm going to need to repeat the comment so that those listening online can hear it, since the mic might not pick it up. We're organizing the meeting in three major parts. They're laid out in our notice for the meeting. We have copies of that on the table in the back. So kind of the first part of the meeting will deal with our draft amendments to the disclosure rules. Part two will be our amendments to the licensing rules. And part three will be some additional issues that stakeholders raised on our notice of intent to review the rules. For each part, I'll briefly lay out some key points, and then we'll turn it over to you to provide your questions and comments on that part. So starting with the disclosures, comments and questions on that, then licensing, then additional issues we described in our notice or other rule issues. Before we get to the first part, I'd like to say a little bit about the timeline and the process for these rules. Texas law directs agencies to periodically review their rules to make sure that the rules should still exist and to make any necessary updates. The process is called rule review, and that's what these amendments are coming out of. As far as the timeline for the rules, I'll try to start this. We are accepting informal written pre-comments until 5 p.m. tomorrow. We call them pre-comments because we accept them before the official comment period that comes later after the Finance Commission publishes them for comment. You can email those to Lori, those informal written pre-comments. We plan to propose the rules at the Finance Commission's August 18th meeting. The Commission will vote on whether to publish the rules for comment. There will be a time for any stakeholders to file official comments during September, and then if things go according to schedule, the rules will be up for adoption at the Finance Commission's October meeting and would be effective in November. Rule updates are available on our website, and we will also, like I said, be posting audio of this meeting. And with that, I will get started with part one on disclosures. Our amendments include a new version of the closing disclosure required by the tax code. Currently, we have a one-page form in the rules with information about what a property tax loan is, the possibility of foreclosure, OCCC contact information, and so on. Our draft would amend the form to include information about the cost of the loan. Last year, the Fifth Circuit Court of Appeals held that the Federal Truth in Lending Act does not apply to Texas property tax loans in its decision in Billings versus Propel. The Truth in Lending Act, or TILA, imposes several different requirements. One of the main requirements is that a creditor disclose information about the cost of the loan before the loan is closed, including the amount financed, finance charge, APR, total payments, and payment schedule. And in light of that decision, we believe it's an appropriate time to revisit the content of the tax code closing disclosure and add information about the cost of a property tax loan. The intent is to make sure that property owners have the information they need to make an informed borrowing decision and that they fully understand the cost of the loan before they enter it. The Texas legislature recognized that much of this information is important for borrowers to know when it added Section 351.0023 to the Finance Code in 2013. That section requires property tax loan advertisements to disclose information like the terms of repayment and APR. And it's our understanding that most property tax lenders are already providing this information in some form. So another thing these rules would do is provide some consistent standards for how to calculate and disclose this information, which again helps property owners make an informed borrowing decision. The amended disclosure is on 2 pages. The first page has the new information about the cost of the loan, and the second is mostly the information that's on the current version, with general information about property tax loans. So I'd like to go through some of the things on page 1 of the amended disclosure before we open it up to questions and comments. So this is the top of the first page of the amended form. The very top is mainly contact information, the borrower name, the property address, and closing date, as well as an option to put a loan ID number. Then the lender's name, address, and OCCC license number. And for residential mortgage loans, the name of the residential mortgage loan originator and their NMLS ID number. Then we have the beginning of kind of the terms about the cost of the loan. On loan terms, we have the loan amount, which is the funds advanced under Section 3206E. We have the contract interest rate, loan term, monthly payment, payment schedule, showing the schedule of payments, and if there were a balloon payment at the end, that's where you would put that. And then a statement about prepayment. For residential loans, this is going to be a statement that the borrower can pay off the loan at any time without a penalty. To the right, we have a section on loan APR calculation. In developing this, we looked at disclosures required under the Truth in Lending Act and used to disclose APR. So this requires 4 pieces of information. The draft rule requires this only for residential property tax loans. So for a commercial property tax loan, you'd be able to omit this section, this little table under the current draft rules. So that requires 4 pieces of information: the APR, the amount financed, the finance charge, and the total payments. Our rule gives guidance about how to calculate the finance charge and amount financed, and the idea is you use those amounts to calculate an APR using the same calculation methods described by Truth in Lending Act and Regulation Z. The bottom of the first page, on the right, there's an itemization of the loan amount. So that consists of 3 different amounts: the amounts paid to the taxing units, the closing costs, and recording costs. And we have just a sample here where you can see what it might look like filled out. So the idea is under amounts paid to taxing units, you would fill in the name of each taxing unit and the amount actually dispersed to that taxing unit. For closing costs, those would break down into the first row, the cost to the lender, and then the other rows, cost to other parties with an identification of who the cost goes to. So you fill in the name of the type of cost and then the identity of the party receiving it and the amount for each of those rows. Recording costs, similar kind of thing, where you disclose the total recording costs and then the amount paid to each governmental unit, whether that's a clerk's office or some other kind of governmental unit. So that's the loan amount itemization, which includes kind of a breakdown of closing costs as well as other amounts. On the right, we have the breakdown of prepaid interest with the total prepaid interest, and then that breaks down further into per diem interest and discount points. For per diem interest, you'd also disclose the percentage per day, number of days. And then we also have a tax office notice. This is the notice provided, described by the legislature under section 351.0023. We kind of took some guidance from that section in developing this disclosure, so this ensures that the disclosure is consistent with that section. So that's an overview of our amended disclosure form. I would like to turn it over to you all to provide questions or comments on the disclosure or on the rule amendments at 89208 and 89502 through 601. As for other issues, you'll have another chance to discuss those in a few minutes. But for now, I'd like to address the disclosure. Again, if you have a really short remark, you can say those from your seat, and if they're more extensive, please come up to the table. So, yeah.
I'll just start with one. Typically, the amounts paid, only having a couple items is appropriate, but could we elaborate if maybe a supporting settlement sheet could be also allowed in the event that there's multiple taxing entities, more than two? And even so, multiple properties, because some counties are not consolidated.
Okay, the question for those listening online was, can you add supplemental pages if there are additional taxing authorities? And the answer is yes. So the text of our rule on permissible changes, we have some amendments dealing with permissible changes to the form, and we did say that you could add additional, I believe, additional pages for additional parties. There's also a bit of room on this first page if you wanted to add some more rows. There are some more, we did leave a little bit of space, so a few more rows will fit on the first page too.
And one last clarification, are the maximum $900 closing costs inclusive of the recording costs?
The question was, do the $900 in closing costs include recording costs? And the answer is no, under 3206E. Our rule doesn't really address that. That's more in statute, but the statute talks about how the funds advanced are limited to the amount advanced to the taxing unit, the closing costs, and recording costs. And that's kind of the amount you're breaking down in this section.
Thank you.
Yeah, Chris.
Quick question on the itemization. Where would you want payments like the district clerk if there's a tax suit going on to be put? Because that's not to the taxing unit directly, but it's a court cost required to be paid.
Okay, so the question is, you have a court cost required to be paid, and that's going to be paid to the district clerk, and who is not a taxing unit. We can take a look at that and figure out what the most appropriate place to put that would be. So that's a good comment. But yeah, we can take a look at that and see if we can address that.
Amounts paid to others.
Yeah, yeah, maybe some amounts paid to others or something like that. So yeah, good question. Thank you. Yeah, Jack.
Don't worry, I'm not going to be too long.
Okay, no, that's all right. That's why we're here.
Speaking on behalf of the TPTLA, we are very supportive of this disclosure that requires tax lenders provide APRs. Our biggest concern is probably we just want to make sure that there is guidance as to what needs to go into the different boxes on the APR. We've seen across the industry and other industries as well, just different calculations and permutations. We just want to make sure that it does achieve the result, which is to make sure the consumers can make an informed decision.
Thank you. Okay. Any other questions or, yeah?
Peter Squire. So the APR is pretty well defined in the TLUC regulations, and essentially any external costs are excluded from the finance charge, and the internal costs are broken down into those are which are mandatory and which would have been incurred whether or not you used that entity, and then the internal costs that pertain to that entity. And so what we found is that two pieces. One is some within the industry are using the internal costs differently, and it would be helpful if you could provide specifics of how certain ones should be done. Yep. And then secondly, there may be some consideration to that when it's an affiliated party, one entity doing the internal costs internally would have a APR that's higher than the exact same entity that has an affiliated party. You know, their APR would be lower because of that affiliation. So some clarity on how that should be treated.
Yeah, so the question was, under TILA and Reg Z, whether a cost goes into the finance charge, and tell me if I'm kind of restating this correctly for the online audience, can depend on whether the cost goes to the creditor or to an external party. And depending on the kind of transaction, whether it's a residential mortgage transaction or some other kind of a transaction secured by a dwelling that's not a residential mortgage transaction, or depending on what kind of transaction it is, some of those amounts may or may not be excludable from the finance charge. Some of them have to be excluded. Some of them are excludable at the option of the creditor, and so on. And the question is, will there be guidance about how amounts paid to third parties are treated for purposes of that? We looked at Reg Z and developing some of these requirements, while kind of cognizant of the fact that Reg Z addresses a lot of charges or issues that might not apply to this type of transaction. And the guidance we tried to provide is on page 11 of our July 13th pre-comment draft, where we define the term finance charge. So I think the general rule is that, you know, the costs of obtaining the loan are included in the finance charge that goes into the calculation of APR. We did allow property tax lenders to exclude recording expenses actually paid to a governmental unit from the finance charge, and to exclude closing costs actually paid to third parties if the costs are bona fide and reasonable in amount. So that was kind of, that's what the draft says currently about what costs to third parties may be, or must be included in the finance charge, may be included in the finance charge. And if there are additional questions or comments about that provision, we're happy to hear those. But that was what we tried to do to create a uniform standard that's kind of consistent, that is something that accurately reflects the costs of the loan, and that the consumer is going to understand to help them make an informed borrowing decision.
Yeah. Comment on behalf of one of our members,
Sure.
CLA members.
Yeah.
There was just a suggestion that the disclosure form should have a signature line.
I believe our current rule on permissible changes has an option to add a signature line. So, yeah, and it's the one that says, there may be something on that in our draft. We did amend the permissible changes rule to, for example, allow the additional pages. So let me pull up our permissible changes rule. Yeah, this is going to be on page 18 of the pre-comment draft. So we already had this in the current version of the form, and we are keeping it for this amended version. That property tax lenders do have the ability to add this optional dated signature block on the second page of the disclosure form. And earlier I was talking about attaching additional pages. That's going to be 504B. That's going to be on page 16. subsection B, that's where we say property tax lender may attach additional pages if necessary to disclose additional taxing units, additional third parties receiving closing costs, or additional governmental units. So that responds to the previous question. Yeah. Okay. Any other questions or comments about disclosures? Lori, do we have any?
Yes, we
online?
actually have someone listening on their phone, and I'm going to see if I can unmute Matt Longhofer to ask his question.
Okay, we'll see if this works. Last time we tried this when we unmuted a bunch of people, it didn't quite work,
right,
so we will try. Okay.
Mr. Longhofer, go ahead.
Can you hear me okay?
Yes, we can hear you.
Great. Okay. I do have a couple questions about the disclosure, and two actually. The first one being as it relates to prepaid interest. You have a in parentheses under that prepaid interest line, it says not included in loan amount, the total prepaid interest. And it's industry practice, or at least I see many people including some portion of prepaid interest in the loan amount, so long as interest is not calculated on that amount of prepaid interest. And so I was wondering if that could be altered, or why that was there specifically written that way.
Right. That is there under the definition of funds advanced. In 3206E of the tax code, it talks about how the funds advanced are limited to, and it lists out a series of amounts. The amounts paid to the taxing unit, the recording costs, the closing costs. Right. So based on that, it's our understanding that prepaid interest is not part of the funds advanced, and the loan amount is the term. It's kind of a more plain language term we're using to refer to the funds advanced.
Okay. I mean, it's funds aren't advanced per se in prepaid interest, but it does become part of the loan balance if there is some prepaid interest. So I'm trying to sort out how we would best manage this in the event that there is some prepaid interest on a loan, even though it is not a true advancement of funds.
Okay. Well, yeah, if you want to kind of write up something for an informal pre-comment or a suggestion about how to change that, we could take a look at that. But yeah, the reason for that is based on the text of 3206E, which expressly limits amounts that are part of the funds advanced. Okay.
And then the other question is, you have the different boxes: loan terms, loan amount itemization, loan APR calculation, and I see how this has resembles very much so the mortgage closing disclosure, the new that's in place now for the mortgage business. Although that's 5 pages, this one's 1, which is great. On the loan APR calculation, the mortgage form uses the heading loan calculations, and for each of the categories, it does give a longer explanation, and I think it's a better explanation because the APR can be confusing to many borrowers, especially on a we'll say a smaller dollar loan that does have some closing costs. There is going to be a fair amount of difference between the stated interest rate and the APR. And I'd like to propose that we look at the language in the mortgage disclosure and potentially incorporate some of that language, because it seems to do a better job explaining what APR is and just the way that's labeled.
Sure. Yeah, if you have specific language you'd like to include, again, let us know. We'll take a look at that.
Okay.
One concern is kind of the space on the form, right? We want to keep things easy to read and simple. So that's kind of the counter concern. But yeah, if there is additional information that would help the borrower make a more informed borrowing decision, we are open to that. And yeah, just let us know what language you'd suggest adding.
Okay. Like, for instance, on APR, you have the first part of their sentence abbreviated, but then on the mortgage disclosure, it says this is not your interest rate, which I think is important for people to understand that, because you've had a discussion with them about an interest rate, then they see this different number and it creates some concern. And so, yeah, but I'll be happy to put some suggestions together for that specific area category.
Great, thank you.
Okay.
Yeah,
I had two comments on
Yeah.
what Mr. Longhoffer was adding. I think it's a good idea for the clarifications, but I'd encourage you guys to make that an optional form. So if some lenders experience a lot of confusion, they may have their own document, a one-pager that they can supply themselves. And two, I like discount points, how it might encourage you to require prepaid interest to be collected up front, out of pocket.
Okay. So there were two comments. One was to make the statement that the APR is different optional, and the second was to require all prepaid interest to be paid upfront. Okay. And we can, requiring prepaid interest to be paid upfront, as the discount points are, is not something we currently have in the rule. We will consider that.
It is part of the discount point rule. William Burns, I mean, our discount point rule does say you have to pay in advance.
Yeah, I'm sorry. Requiring per diem interest to be paid in advance is not currently part of the rule. But yeah, discount points are a type of prepaid interest that are currently required under our rules to be paid upfront. But okay, we can consider that. Yes.
I believe this is going to be required as is, but I know some of the disclosures, we just have to make sure we can use our own form, but they have to contain all of the different pieces. Are you envisioning that this actual form in this format will be required? Or just all of these pieces need to be covered in whatever disclosure we provide?
Oh, okay. So the question was, does the form in this particular format need to be provided, or could lenders create their own forms containing the same information? And I would say that lenders need to use the form in this form subject to our rule on permissible changes. So our rule on permissible changes goes into the changes that can be made to, like, add the names of the parties and change a few different pieces of terminology, and add or delete rows regarding the charges and the taxing unit. So those sorts of things. We want lenders to, be able to amend the form subject to those permissible changes. So as long as it's a change listed in that rule, that's kind of how we approach
And the
that.
reason I bring that up is I would say probably 25% of what we would use will need more lines than are available there.
Okay.
And then it goes on the next page, and it,
Yeah.
So, with the intent of being easy to read, and
Sure. Yeah, like I said, the rule does allow additional pages for disclosing additional costs and amounts paid to extra authorities. But yeah, the place to look is the permissible changes rule.
Yeah, my suggestion would be to look at the permissible changes rule and see if that accommodates what you think your particular situation would need. And if it doesn't, please make suggestions on how the permissible changes rule. But we are looking for a more uniform type of disclosure, so we are looking for that particular statement, but with some modifications as allowed in the changes rule.
Okay. Any other comments, questions on the disclosure rules? Well, I've been told to wait about 15 seconds after asking a question just to see if anyone.
Or moving on.
Yeah. No.
To emphasize Chris's point about amounts paid to others, we have counties where they won't sign the tax lien unless we pay the lien. So it's not just court sometimes, that they will, I don't want to use the word blackmail, but that's kind of what it is, where they'll require a payment of a weed lien or some other miscellaneous expense or cost due to them before they will sign the tax lien transfer. So I know the agency had some questions about that from lenders
So the question was building on the earlier point about amounts paid to the county. It might not always be a taxing unit. The county might require other amounts for other liens, such as a weed lien. And kind of building on the point that the amounts paid to the taxing units might not always be to a taxing unit. Okay. Any other comments? And there, if you think of something about the disclosures, there'll be more time at the end to bring those up. Oh, we have.
Okay, I think Mr. Longhofer has something further, so I'm going to unmute you, and you can go ahead again.
Can you hear us?
Hello. Yes.
Hi.
Sorry, I missed one thing. On the disclosure, you do have the tax office notice disclosure that was added to there, and I'm just looking at that, and then looking at 351. It appears that language was really targeted around solicitations, and when I look at this is a disclosure they're getting at closing. It's not really, we're not really in the solicitation mode, so I just wonder why this is included on there.
Okay. So the question is, this is a closing disclosure. Why is the consumer or the property owner borrower receiving this, and was that disclosure intended more for solicitations? I'll note a couple things. One is the current disclosure form requires something similar, and also for residential property tax loans, the consumer borrower is going to have a right of rescission. But yeah, I guess we can kind of consider that point that this is a closing disclosure. But I think there could be situations where it would be helpful to the borrower to know that, and it is something that's part of it uses somewhat different language, but it is also part of the current disclosure.
Well, I mean, there is, in the current disclosure, it talks about how you may have other ways to pay it. You may be able to borrow from friends or family or private lenders. But that specific language about your tax office may offer to delinquent installment plans is not part of the current disclosure. It's only part of the solicitation requirements. And so, I mean, I look at this and go, well, by the time they've got to this point, they've been on our website, or they've seen our advertisements, they've seen this solicitation disclosure multiple times. To put it on here again, I think is overkill.
Okay. The language I was referring to is on in the you may have alternatives to this property tax loan. The second section of that, you may arrange with the taxing unit to enter into an installment agreement for the repayment of these taxes. As I was referring to, kind of somewhat similar language, but we take the point that the consumer is getting that information in more than one place, but we again believe that the legislature determined that was appropriate information for borrowers, and that if you think that should be removed, then you can submit that and we'll consider that.
Okay, thank you.
Okay. Any additional questions, comments? Oh, yeah. Peter.
On page 2 of each of these proposed disclosures,
Yeah.
The third section discusses you have alternatives, which Matt was just referring to. And, since this original form, the legislature changed it such that we cannot make a loan to anybody over 65. And it may be appropriate in that first section to change it. So if this property is your homestead and you're disabled, or you are over the age of 64, you may be eligible for deferral.
Right. In 2013, we amended the disclosure form to remove that statement. Before 2013, we had a statement, if you are disabled or 65 or older, you're eligible for a deferral. We removed that because if someone's 65 or older, they shouldn't be getting a property tax loan in the first place, so they shouldn't be even getting this disclosure. So that was our rationale for leaving 65 or older out, was that if they are 65 or older at the time they're getting this, they shouldn't even be getting this. they should not be getting a property tax loan. So that was our kind of reasoning for the 2013 change. Okay, well, I will move on to the licensing rules. But again, if you think of other disclosure-related comments, we'll have some time for those. Okay, licensing. Our amendments to 89-301 through 89-405 have to do with licensing. They relate to issues like maintaining updated contact information, where we send delinquent renewal notices, and so on. So in 89-301 and 89-302, we're removing a requirement to list spouses with community property interests. These changes, by the way, are consistent with changes we've adopted for our other licensed areas, like credit access businesses, motor vehicle sales finance licensees, and regulated lenders, and pawn shops as well. So again, we're trying to bring some consistency to our licensing processes. 89-306, requiring licensees to maintain updated contact information. And then 89-403 specifies the method by which we send the delinquency notice for the annual license fee assessment. Some of our changes deal with license transfers. The intent here is to clarify our current rules requirement at 89-303 when a licensee transfers a license, and also to allow a second method of transferring ownership of the business, which is what we're calling a new license application on transfer of ownership. The important thing to remember about this rule is that licensees would still be able to use the transfer procedure that's in the current rule. Although we are repealing and replacing the current 89-303, licensees would still be able to use substantially the same procedure to transfer their licenses, including the permission to operate, which allows the transferee to operate while the license application is being approved. We're just adding some clarity to those requirements. One thing the rule would allow is for the transferee to operate. It would allow the transferee to operate until denial of the application or the permission to operate, assuming the transferee files a complete application. That's the license transfer rule. And then for criminal history, we're the draft repeals and replaces current 89-405 and 89-406 with a new 89-405. We have two rules about how we treat the criminal history of license applicants. Our intent is to update the rule to more clearly identify our statutory authority to use criminal history in making licensing decisions under Finance Code Chapter 351 and Occupations Code 53, Chapter 53. The rule updates references to the Occupations Code, and it combines offenses in the current rule for moral character and directly related offenses into a single list of criminal offenses we consider in making licensing decisions. And the criminal history rule is also, we made similar changes to our residential mortgage loan originator licensing rule a couple years ago. So again, it's part of trying to bring some uniformity and clarity to our licensing procedures. So those are the licensing rules. Do we have any comments or questions specifically on those licensing rules at 89-301 through 89-405? And again, we'll have opportunity for other comments and questions in the next part, but specifically on the licensing rules, any comments or questions? Lori, anyone online? Nope. Okay, wait a few more seconds just to see. Okay, and if you think of a question, we will have another chance here in a couple minutes. So with that, I'll move on to part 3, additional questions. So when we put out our notice of intent to review these rules, we got some comments on that notice of intent. And we wanted to provide an opportunity for everyone to respond to a couple questions we had about those. So we put out 5 questions in the meeting notice. We revised the notice earlier this week to put out some additional questions in response to those comments. We invite responses to these questions as well as any other comments you might have, but these were issues that we wanted some additional information on. So the first question has to do with the scope of the closing cost rule at 89601. Currently, that rule states that it applies to property designated as Category A, which is single-family residential property, or Category E, farm and ranch improvements, if it's a homestead. And our question is, what would be the benefits and drawbacks of amending 89601A to specify that the rule applies to a property tax loan that includes a lien on property owned and used by the property owner for personal, family, or household purposes, which, if that amendment were made, it would make the closing cost rule consistent with some other requirements that apply to residential property tax loans, like the prohibition on prepayment penalties and the new closing disclosure in our draft rule for residential property tax loans. So that's kind of the first question. I'm just going to go through these questions and then turn it over to you guys to provide questions or comments. Also, these questions, again, are listed in the revised meeting notice, which there's a copy of in the back.
Sorry, on page 3.
Yeah, page 3. So the second issue has to do with additional closing costs for additional parcels of land. And currently, our rule in 89601C4 addresses this. It allows $100 in additional closing costs for each parcel of Category A or E property. The question is, and the request we got from stakeholders was to make that available for commercial parcels as well. So the question there is, what would be the benefits and drawbacks of amending 89601C4 to allow $100 for each additional parcel of property, regardless of whether it's residential or commercial? The third question relates to the rule on filing a lien release, fees for filing a lien release at 89602. One stakeholder said that the actual cost of this can exceed $110, which is the current maximum aggregate fee. So question, what costs have stakeholders encountered in filing a lien release? What are the actual costs charged by county clerks? And what would be the benefits and drawbacks of amending the $110 maximum in 89602C? The fourth question had to do with the tax code's prohibition on property financed by below market rate loans from governmental entities or nonprofit organizations. And stakeholders requested some guidance about what below market rate means. And what we'd like to know there is what types of real property financed by governmental or nonprofit loans have stakeholders encountered? What rates have they encountered? And is it unclear whether they're below market rate? And what would be the benefits and drawbacks of adopting a rule? And then the last issue had to do with authorizing additional costs for modifications. And in particular, some of the comments we received asked for additional closing costs upon a modification. And the way we've generally viewed this is that modification costs are not closing costs. They are a post-closing cost because the loan's already been closed and you're now modifying it after the closing. In order to get new closing costs, there needs to be a new closing, which could happen in one of two ways. There could be a new loan or a refinance, which is a type of new loan that satisfies and replaces the previous loan. The costs of modification, we've previously understood those to be post-closing costs that the legislature expressly limited in section 351.0021 of the Finance Code, which has only a couple of narrow situations where it expressly authorizes modification costs in situations like where the modification is necessary to avoid a foreclosure, or where you're providing extra copies of transaction documents on top of what you've already provided to the borrower. So that section expressly limits post-closing costs to amounts that are listed in that section, and it's pretty narrow about the modification costs it authorizes. And when we've been asked for guidance on this issue, we've kind of laid out, we've been asked for guidance about how a property tax lender who has an existing property tax loan with a property owner can advance money for payment of a new year's taxes. So existing property tax loan in year 1, year 2, the same property tax lender wants to advance money to pay the new year's taxes. The possibilities we've identified for that are, like I said, the new loan, which then you'd have 2 loans with the same property tax lender. The modification, where you modify the existing loan to include the new year's taxes, and you ensure that costs for that modification are limited to the post-closing costs expressly authorized by statute. And then the refinance, where it's a new loan that's getting closed that satisfies and replaces the previous loan and has an advance of the new year's taxes. And then because there's a new loan being closed, there can be closing costs in connection with that. So in kind of response to the questions about can our agency amend the rules to authorize additional costs for modification, what we'd like to know is, regarding those 3 possibilities I've laid out, are there concerns that aren't addressed by those 3 alternatives? And is this an issue appropriate for OCCC rulemaking, or would it be more appropriately addressed through legislative amendments to 351-0021? So with that, I will turn it over to you guys to provide comments. If you, we welcome responses on these questions and any other issues you identify. And if you have thought of issues on disclosure and licensing that you forgot to bring up before, you can also share those as well. Yeah.
Sorry. I know we've already submitted comments on this, and I don't want to be repetitive, but I don't know, maybe it's just me, but my understanding of a modification, it doesn't include the payment of taxes, and I'm more to a reinstatement modification where someone has fallen delinquent. A tax lender, in order to prevent that person with the account to be delinquent, let's say over 6 months, they either lost a job and they're wanting to get straight again and get current. It's, in my opinion, a good faith modification to reinstate that. We're faced with an attorney's fees of preparing the documents, sending out a notice to the person, additional reporting fees, and some internal processing fees. And I think maybe there should be some post-closing allowances for a good faith modification, because there are instances where it does make sense. And my term for new payment of new taxes is a refinance, where a modification doesn't include the payments of new taxes.
Okay. So the comment there was that, in your business you do a reinstatement modification for payment of delinquent, or when someone's delinquent, that can include costs like attorney's fees, and you believe it's appropriate to allow those. Yeah.
I'm sorry, I don't mean to understand. I think the current rules allow us to only charge for reporting fees, but they don't allow us to charge for attorney's fees or notary fees or some costs that we incur.
Yeah, so the statement was that, currently the post-closing costs, including costs for modifications, are limited. The limitation is actually in the statute. It's in Section 351-0021, which has this exclusive list of charges that can be imposed after closing. It does include certain types of attorney's fees, but again, it is limited to specific kinds of charges. And like I said, that limitation is in the statute. We can't change the statute through a rulemaking action. So yeah, the question here is, are there changes that would be appropriately made to the rules on this issue? And if so, what would those changes be? Yeah.
Jack, are you gonna go?
No, you.
So, and Laura, here's just a copy of these where you printed out. So again, I'm Peter Squire with Hunter Kelsey, and just going down your list.
Oh, could you try to lean into the mic?
Yeah.
Sometimes the mic doesn't pick everything up. Okay.
I'm Matt, are you out there?
Yeah. Okay, we can hear you.
So, on 89-601,
Yeah.
this is, definitely support this change. It's, the only place category A and E references are made. They're not in any of the statutes. They're only in this rule. And it's inconsistent with what's in the statutes, which is personal, family, or household purposes.
Okay.
And I think it's a great idea. It would avoid some confusion. And my understanding of the implications of that are that personal, family, or household certainly applies to homestead. Sometimes people don't actually file the homestead exemption, but
Right.
that is applicable to them.
Yep.
And it's also applicable to secondary, like vacation homes.
Right.
And if they rent to direct family member, those would all be applicable. That's what this change would mean. And I think that's appropriate. And what it would exclude is 1 to 4 unit housing that is being rented property. And that rented property is generally more of a commercial, transaction than a residential transaction.
Right.
So I think it's a great idea, totally support that, and I haven't heard anybody in our association disagree with that change.
I did have one question on that, which was, assuming you know that the property, let's say you know the property is category A, and there's no homestead exemption, the person hasn't filed a homestead exemption, how do you know whether or not it's, property used by the owner for personal, family, or household use, or the kind of some other unit or vacant unit that's not being used?
So we can't, but what we do is we make them sign an affidavit of that they have another homestead or that they don't have a homestead.
Okay.
And if they won't sign that, then we assume it is a homestead, because if we assume it's not and do documents that way, and it is, and they can show that, then we've done not an illegal transaction, but our transaction is subject to a loss.
Okay. And do you maintain all that documentation so the agency would be able to see it? Okay.
So I think that's a great change. Thank you for proposing that. Second, the cost of extra parcels. So I have an example, I can provide that to you, but several of the counties around Texas have multiple taxing jurisdictions. So Dallas, Harris, Brazoria, Fort Bend, Webb, Cameron, they have holdout school districts or others that tax separately. So part of the challenge with this $100 for an extra parcel and not $100 for an extra tax lien transfer is when we did four taxing entities in Harris County, a MUD, a Bridge, the school district, and the county itself. We have to generate 4 sets of tax lien transfers, sworn authorizations. We have to pay our attorneys to do that, and then we have to file all those. And so we have a lot of extra work on those. And so $100 just doesn't cover our incremental cost to do that. And so we'd like to see that remedied, and one way is to change that from a parcel to a tax lien transfer. But if it's easier to keep it as a parcel, then I would like to see that maximum amount raised to cover situations like this, and then basically let the market prevail on what people are actually charging. And if it's kept per parcel, I would suggest $150 maximum per extra. And then presumably with the Category A and Category E changes that you're proposing, then that would mean, that would cover those as well. So if you're adding an extra, we have customers that they want their homestead loan, and then they have an extra piece of land that's not contiguous that they don't consider, and they want just one loan, one set of documents to sign, one payment to make. But if we mix them, the land is not residential, we have to do it for free currently. It's just not right. So,
Is there specific information you could provide to us about the amounts of those costs?
sure.
Okay, I think that would be helpful for us to see.
It's primarily just what our attorneys are charging us, and we do have some, internal work, but yeah, I can provide that.
Sure.
On your third point, fees for filing lien releases, may I ask, I guess we're acting conservatively on this, but so if I have one piece of property in Harris County that has 4 different tax lien transfers associated with it, is the $110 limit pertain only to that one releasing that tract, or is it pertain to the 4 different tax lien transfers that I filed on there?
William, do you know off the top of your head the answer to that?
This is William Purse. Our regulation doesn't really address that issue right now.
Okay.
And that's really maybe my request. So if it's a tax lien, if it's per transfer, then the caps, $35 and the $110 maximum, are appropriate. But if it's a per parcel, then the same issue when we have multiple taxing jurisdictions, we're not recovering our costs, and we'd like some change on that. The second thing I would just say in general about all of the fee caps are that, with the exception of the $900 ones, a lot of the release fee, the payoff fee, they were all established 10 years ago as a maximum, and 10 years of inflation has now occurred, and so just sort of some kind of cost of living adjustment, so that those are keeping up over time. If you all don't get to this again for another 3 or 5 years, it's going to be probably 30 or 40% change from those original caps. So we'd like to see something pertaining to that. And one of the things that we do that isn't required, but by allowing a slightly higher amount, makes it easier to digest. And I'm afraid, we're large enough we can kind of afford to do it. I'm not sure some of the smaller ones can. But the counties ask us, hey, when you release this tax lien transfer, would you send us a notice and let us know? That's one of their biggest gripes. They get released and they don't know, and they show it on their records as still being there. It's not required by statute. It's not required by y'all. It's a good practice, but it's one more thing we need to do and take the time, to send to the counties. And I think that would behoove us all, keeps us in the good graces of the tax collectors. On your fourth issue, any questions on that? So on your fourth issue, property financed by below market rates, there's really 2 issues. One is government entities, and then the second is below market rates. And pertaining to the government, really the below market rates can sort of be figured out, but the government, when these were first made, actually maybe not, but since, pre-2007, the government was hardly in the mortgage market, and now they're almost in the entire mortgage market, right? And so my request would be to just clarify and just exclude all of the federal types of programs and leave the state and local, things alone, which I think is what the legislator wanted, because it was really Texas-based, and there were a few programs in the Valley. The gentleman came up and testified about how they were helping people in some of the colonias, and they were subsidizing that, and they didn't want those having tax liens on them. So what I've provided to you, Lori, just shows Federal Housing Administration, Government National Mortgage Association, it's Ginnie Mae, U.S. Department of Veterans Affairs, the VA loans, Housing and Urban Development, U.S. Department of Agriculture. Those are the core federal programs that back mortgages. And you could say, because the federal government's backstopping that these, in fact, are subsidized in some way. And so it'd be great if those could be specifically excluded.
Okay, so just so I'm clear about what you mean by excluded, the tax code says that you cannot make a property tax loan on property that has been financed with a grant or below market rate loan provided by a governmental program or nonprofit organization and is subject to the covenants of the grantor loan. Your suggestion is that we interpret a governmental program or nonprofit organization to just refer to federal,
to exclude.
oh, it does not include
Right,
the federal programs.
clarification.
Okay.
So we've had issues with, we're trying to, y'all want us to charge lower interest rates. We're trying to, get, institutional money. They have got their bean counters with glasses on looking at things going, wait a minute, this is a potential risk. And these are things that I just want to reduce the things that can be ambiguous that hurts.
So you think the Ginnie Mae, the Veterans Affairs, the HUD loans are not loans provided by a governmental program with a below market rate, and that you should be able to make a property tax loan on properties subject to those things?
Right. I don't want some attorneys saying that those federal governments are actually below market, or they're somehow trying to invoke this clause. So I'm nitpicking on a piece of that, but I don't know really how else to qualify this.
Do you have any information about rates in connection with those types of loans?
No. Frequently what happens is a housing authority, like Austin Housing Authority, will work in conjunction with a FHA loan, and they will provide some money for that, and that's a second lien, and those are ones where we'll say, well, okay, actually that one's unclear also, but we just back off of that, and we're not serving the market that way because we don't want to risk violating this clause.
Okay.
The last point, the cost for modification, 351.021 defines the post-closing types of costs that are allowable, and you referred to that, and Eric referred to those. Number 4 has reasonable and necessary attorney fees and core costs for actions that are required to support a Chapter 33 tax suit, right? So there's clearly the intent to make sure that that's there. But, number 10 says, and this is what Eric was alluding to, recording expenses incurred in connection with a modification necessary to preserve a borrower's ability to avoid a foreclosure proceeding. And what that doesn't say is the attorney fees to avoid a foreclosure proceeding. If the foreclosure goes through, then attorney fees are suitable. I think we're all best served if we don't foreclose on the consumer. If we can work out something where they finally start paying and come back, we don't want to foreclose either. It's bad for press, it's bad for the consumer, it's bad for us. But right now, very frankly, it's going to cost me about $500 to have an attorney remodify the loan for the customer. There's no new money advance, so I can't do it under that rule. And I just think it's right. So the statute, it's going to take a little bit of putting together a couple different pieces in the perceived intent of the statute to come up with something that I would call, fees for default modifications. So if they're in default and they're already at a law firm to be enforced, that the law firm has the ability to charge to modify their loan. And I believe there might be some in the industry doing that under the guise of, well, actually, this is part of the foreclosure, and they're, they didn't do the foreclosure, but they were going down the foreclosure route, and so we can just tack that onto their bill. We don't do that because it's unclear. I'd like to be able to do that, and I found myself denying modifications because I don't want to eat the $500 on this low margin loan. So that's at least my perspective of that, and I understand your dilemma because it says very clearly, these are the only things that are allowed, and it's got to be explicitly interpreted.
Yeah.
So
that is the main concern, as we want to make sure that there is statutory authority for each rulemaking action. So.
Okay. Any questions for me?
I have one quick one. Rudy Aguilar, Consumer Credit Commissioner. On the comment you made on that first issue, you were talking about, homesteads or vacation homes or renting to a family member. Did you have some established standards for family members that you?
There is actually federal mortgage lending that defines this type of thing. It's like, I think you can go above you or below you, like your parents or your children, but not your brothers or sisters, something like that. And I'll find that for you. I'll provide that.
I have have one question. It's way first. One of my questions would be, what would you have about, where would you consider a home where they inherited it, their family members?
Good question. And what we find is that they're living in the inherited home, but it was under, when they died, it was under the parents' name, so they couldn't declare it as a homestead. And then as soon as they die, there's one or more children living in there. But and it hasn't been probated, right? And so it's actually in this sort of limbo land. And we consider it a homestead. We'll just treat it as a homestead loan that way. Maybe some of the attorneys here might have a more formal position on how that should be treated. But if it's their homestead and we don't treat it as a homestead loan and give them the homestead documents and all, we're afraid that we've got an invalid loan and an invalid lien, and so we don't do that. Thank you.
Okay, thank you.
Paul, Fed Ovation, Financial Services. I would really like to second Peter on his point one, making the language consistent, taking out the A and E and making everything. We do the same thing with the affidavit, not homestead. And the inconsistency of that language makes us, you have to apply different standards of the different rules, and it does cause confusion for our loan officers. So I'd just like to second that. But also, one slight correction, 3206B does require us to send those to the collector.
Okay.
That's actually a statute that we're supposed to be doing that, but then you do.
Notice of release.
Yes, really, so then the collector, 3206B last sentence.
Well, maybe that's why we're doing it.
Okay, so yeah, Paul seconded Peter's comments about amending 89601A and noted that 3206B requires notice to the taxing unit of the release of lien.
I wanted to add to Peter's comments. For number 3, the release of lien rules. I think a lot of county clerks have changed since this 110 was instituted in 07, 09, I'm not sure when it was. For instance, Cameron County charges $36 for the first page now. So and on top of our actual attorney's fees and perhaps additional exhibits, it becomes costly. At some point, we are not covered. And I think allowing to charge us actual fees that we incur is reasonable. And also, for number 4, below market rate, it's very confusing. I would encourage the OCCC to define that, maybe to some correlation of crime. For instance, we encountered a not-for-profit fund in San Antonio, which the confusion was, what's their interest rate? And sure enough, it was 10% on a $100,000 balance on a commercial property. So, being non-for-profit didn't extinguish this, and I believe that was a well above market rate, but I think we should, clarify what that is, and I would encourage some fixed rate signed at signing in reflections of crime.
So there were 2 points there. One was about costs from counties, that Cameron County has increased costs. If any of you have any specific information about costs charged by counties, we would really like to take a look at that. We want to, in looking at the cost rules, we want to make sure that any amendments to the cost rules are, the more data we have about amounts, the better, the more informed basis we would have. Again, we haven't put out a draft of changes yet. We're trying to gather information, but yeah, any information that anyone has about specific amounts that counties are charging or that you incur in complying with these rules, we would like to see that. The second comment was about below market rate, and with some of these nonprofit groups, there can be varying rates. The suggestion was that the agency provide guidance on that. Anyone? Oh, we have an online comment.
Yes, Mr. Longhofer,
Okay,
you there?
can you hear us?
Yes, I am. Thank you. By the way, this system's working really well. I appreciate you guys giving us the opportunity to call in remotely and ask questions. I had two things that were part of the letter that the TPTLA sent in to Ms. Hobbs on the comments. And one of them is around insurance and insurance being rolled into the closing costs of the loan. And I think that the statutes, it's pretty clear, or Chapter 31 is pretty clear that, we can force place insurance on a property as part of a post-closing expense or post-closing cost. So that's defined. And 3206 is pretty clear on what can be included in the transaction. And insurance premiums is not one of them. But we are seeing examples of the industry where closing costs are being financed into the loan at closing and part of the transaction at closing. So I think there needs to be some clarity on that in that practice.
Okay. With the premiums for insurance, that when we've encountered that, that's been kind of a case-by-case situation where there's been kind of different things we've encountered there. You're right that there is express authorization to place collateral protection insurance after the loan is closed, provided the property tax lender complies with Chapter 307 of the Finance Code. We haven't really understood an advance for property insurance as part of closing to be something that can be part of the funds advanced. So that it has seemed to us to be, something like the financing of an additional product that is not in the amounts that the legislature laid out as being part of the funds advance. Typically, the other chapters of the Finance Code that we regulate will expressly list out the insurance charges that can be listed or that can be included in the principal balance of the loan. And the Chapter 351 of the Finance Code and 32 of the Tax Code, the only authorization there for insurance is the collateral protection insurance. But if there's a specific suggestion on that,
I think the suggestion from the TPTLA is that not be allowed, or if it is allowed, it be counted as part of the closing costs. But under 3206, it's not allowed to be financed in the loan. So we think there just needs to be some clarity on that for the industry, so that if it is being done, that practice is curtailed.
Okay.
And then the second thing from our letter was, as it relates to taxes being paid under 33.455 or 445 under the tax code, where there's a delinquent tax suit and taxes are paid without an authorization, we would like the ability to modify the transfer to say that the transfer is being paid under that code rather than 3206. That's when we're sending in a transfer without an authorization to protect our lien interest for the tax suit.
Yeah, on that point, you're talking about the taxing authority's certified statement, is that correct?
Yes. Yes.
Okay. Do you have any information from the taxing units that they want to be able to do that, or are they trying to do that?
Most taxing units use the forms we provide, the promulgated forms. Others will draft their own forms. We haven't seen resistance when we have included the addition of the 33.445 language, but I don't know that we're compliant with the law when we do that. So we're just trying to address that issue. It's kind of a minor technical issue.
So you have made the change, and then you provide that form to the taxing unit, which then signs it and returns it to you?
Yes.
Okay.
We just want that to be permissible.
Okay. Okay, thank you.
Okay. That's it. Thank you.
All right. Any other comments in response to these questions or things you may have thought of on disclosure and licensing that I forgot to bring up?
Are we gonna,
Oh, yeah.
I have another comment not related to these.
Sure, we're happy to hear it.
Yeah, sounds good time.
Oh, okay. I wrote about it in my letter, and it has to do with reasonable attorney's fees at point of conflict here.
Yeah,
Sure,
make it,
yeah.
It has to do with reasonable attorney's fees for the Chapter 33 collections. I'm not an attorney, but I understand the Chapter 33 collection rules are extensive, and the attorneys who represent my company have informed me that some county, some tax masters, some judges are disputing the definition of reasonable attorney's fees. And their argument is on a $2,000 tax lien loan that's defaulted, why are there $3,000 in attorney's fees? And our loans are smaller in size by nature. I think the average loan size is roughly $10,000 across the board. And I just implore the OCCC to define that actual attorney's fees or reasonable attorney's fees are defined by actual work provided, supporting documentations of notices and supporting invoices. And I encourage that the balance should reflect the fees because, I think a lot of our loans are under $3,000, and if we can't enforce them, that might result in higher charges or costs or rates for new customers. And I'm open to any questions.
Yeah, the concern with attorney's fees is, again, that's kind of a fact-specific, case-by-case question. We do, well, like you were saying, expect that all of those costs will, at a minimum, be supported by invoices that property tax lenders maintain as under our record-keeping rule. The challenge is that defining what is a reasonable attorney's fee is just a very challenging thing to do in a rule. And where we've encountered it has been that kind of case-by-case, fact-specific analysis. But if there are suggestions, about what those standards might be, we can hear those. But again, it is a very, very challenging issue to address by rule because of the fact-specific nature of it.
Thank you.
Okay. Any other questions, comments? We'll wait 10 more seconds. Oh, yeah.
All right.
Sure, no.
Wait until you got to walk.
Okay, yeah. Keep us in suspense.
Just some general requests, I guess, Matt, maybe I'll come up here.
Sure, yeah.
They don't have to repeat. So, Matt had asked about, how prepaid interest should be handled, and I guess, just some clarity around, there's a normal amount of, well, your first payment isn't due until this day, and so there's gonna be some interest that accrues,
Right.
There. But then, I'd like to have some clarity on if they say, look, and we have some of our customers, they are seasonal, they get paid seasonally. So they may not have any money for this period, and then they get a lot of money later. And so sometimes they call up and they say, look, I need a loan, but I'm just going to be honest with you, I'm not going to be able to pay you for 90 days or 120 days or something. And so how if we go that long, is the commission expect us to not charge interest there, charge interest but not be able to earn interest on that interest, which I believe is the case. But how should that be handled in the disclosures? I wasn't really completely clear, so if you could help bring clarity to that, that would be great. There's been issues within with within the industry about what constitutes an emergency so that the 3-day right of rescission isn't, apply. And that's been liberally used by some more than others. And one of the things that would be useful is, if it's June 30th and they're going to get a 23% increase in their tax bill, if we could just do it now but sorry, 3-day wait, and so then they have a 23% extra penalty. That's the extreme one, right? But that just doesn't seem fair. And so, if we could say avoiding penalties or interests that will apply constitute an emergency for the purposes here, that would be the best thing for the consumer. And if they're uncertain, then they don't have to do that if they want to read over the document or whatever. So that would be one thing. There's some uncertainty. I couldn't exactly tell in how the new disclosures are to be delivered and the timing of that delivery. So there was a 3-day thing that got scratched out, and so whether the e-disclosures are going to be suitable now, and whether they have, one thing that's unclear that our attorneys have told us is if you e-disclose, you have to get a consent for e-disclosure before you actually receive that. And if somehow you could clarify what's required on that, that would be great. But my reading of the proposed changes is that, and I'm going to go to the extreme to make the point, is that, Mr. Nancy want a loan, here's our disclosure. Okay, you haven't seen anything. You just, you're showing up and there's a mobile notary meeting you at a Wendy's in San Antonio, and okay, here's the disclosure. Okay, here's your loan documents. Is that allowable or not? So that would help to understand, what the timing will be. And if maybe you can comment on that, or.
Sure. And I may need to look at Lori's notes real quick, but so the first issue was prepaid interest and clarifying a few different situations you laid out. If you could maybe in the pre-comment or something filed by tomorrow kind of describe those situations. I'm not sure if I have a complete answer about how to do each of those right this moment, but yeah, if you wouldn't mind just kind of laying those out to make sure that we understand that and if appropriate provide guidance on that. What constitutes an emergency for purposes of the right of rescission? So the tax code explicitly refers to Regulation Z when it talks about the right of rescission. And the Regulation Z provision referenced there kind of goes into that. I think the intent of that was not so much for kind of situations with like penalties and that kind of thing. But, if you have a suggestion on that, we could consider that. Again, the waiver of the right of rescission, I think it's important that that not just be some kind of form document that consumers are being pressured to sign or anything like that. Because, what the benefit the right of rescission provides is kind of the opportunity to reflect and think about the transaction and that kind of thing. And the delivery of the disclosure, we have a current rule about delivery of the disclosure that I don't think we are substantially changing it, but except for the timing. You're right about the timing, because this is, providing very transaction-specific information, and because the statute, unlike TILA does for residential mortgages, where you have kind of an initial estimate and then later the closing disclosure, the tax code just mentions a disclosure to be provided before execution of the transfer. So you're right that we are amending the timing because it's our understanding, you might be developing that information specific to that transaction, and we do expect it to be accurate, for that transaction. So yeah, we are amending the deadline for that. But yeah, if there's the other issue was about e-disclosure or electronic disclosures, and yes, we do expect for electronic disclosures that there's the Federal e-Sign Act, which, as you were saying, has requirements about getting consent and making sure a copy remains available to the borrower, the consumer. So yes, we do expect licensees to comply with those requirements, but there is an opportunity to provide those electronically.
And one sort of related thing is there seems to be a pretty good movement of, for electronic notarizations.
Okay.
And I might ask that if, I don't know how frequently y'all do this, and every, 3 or 4 years, maybe revisit the rules?
Scheduled for 4 years, yeah.
So I would hope, and before 4 years is up, that we're able to do notarizations, and so if there's some type of provision that upon it becoming, legal or whatever, however you might want to define it, then it would be acceptable. So kind of looking ahead and just putting in something that once it's okay, then it's okay for us here.
Okay.
I believe the association might have addressed this, but the counties can currently charge for debit card payments and or e-checks. And so if there was some way to, I don't know if that's finance code or not, but if there was some way to allow that to be, is that finance code? Okay.
Well, charges for paying by credit card, it's our understanding that those are a post-closing cost that, again, would be subject to the statute, the 351.0021, which expressly limits post-closing costs. There's also a prohibition on credit card surcharges, which is being transferred from the finance code to the business and commerce code. But,
Except for governmental agencies.
yeah. So, right. So that might have to do with if you see the county doing that kind of thing. But yeah, it's our understanding that that is a post-closing cost that's not expressly authorized by 351.0021.
That's all I have. Thank you so much. I appreciate you all being here.
Sure, thank you. Okay. Any additional comments? Lori, do you have additional online comments? Okay. Well, thank you all so much for coming. Again, stakeholder input is very important to us. You will have until tomorrow, 5 p.m. to file informal written pre-comments. The more specific information you can provide, the more helpful that is to us. Again, on some of these issues with costs, if you can provide us with amounts, that's helpful. If you can provide us with specific suggestions for amending the rule text, we can take a look at those, and that input will help ensure that we can produce the best rules possible. You can send you can send your pre-comments to Lori. Her email is